Now, unlike a lot of other things where Uncle Sam wants to get into that and take some of it out, so that's a great benefit right there. Now, we say generally because there are a few situations now and then that would cause that benefit to be taxed. But our agents work real hard to make sure that everything is structured so you don't have to pay income tax on that. All right, and then finally, benefits can be used to pay for anything from medical expenses to college tuition or even an outstanding mortgage. There are no restrictions on that, the benefits. So let's talk about those living benefits, or ABRs, accelerated benefit riders, okay? They're provided at no additional premium, can allow the access to all or part of the death benefit for a qualifying illness or injury. Now, what does that mean? That means if you have one of those qualifying illnesses or injuries, you can accelerate the death benefit. If it's $300,000, you can accelerate part of that or all of that in certain circumstances to cover your needs during the time that you're still living. Okay? You don't have to wait till you die. So you don't, in many cases, it avoids having to build up a lot of loans and that sort of thing that have to be paid off. You can avoid that. All right? You receive an advance against a policy's death benefit and have the freedom to spend it without restriction. So heaven forbid somebody is diagnosed with a terminal illness, they could say, okay, I want to access my death benefit and take a trip around the world with my spouse. You can do that. It's up to you while you're still living. That blew my mind. Maybe it does yours as well. So how do you access these ABRs? Well, there are 4 different ways. Number 1, terminal illness in the event that you're expected to die within 2 years. Excuse me. That would be considered terminal illness. And then that lets you access that death benefit, like I explained, while you're still living. The second is chronic illness, where you're unable to perform certain activities of daily living. The third would be a critical illness. We all recognize this stuff, right? Cancer, heart attack, stroke. And the last is critical injury such as paralysis, traumatic brain injury, and coma. Heaven forbid we have any of that. But if we do, we can access that death benefit and use that money to pay those expenses so we don't have to worry about going bankrupt or foreclosure or anything like that, like we talked about on that one slide. Okay? Now, living benefits also has policy loans and withdrawals. Cash value accumulation can be used during your lifetime through policy loans and withdrawals. There are no restrictions on the use. So as the longer you have it, you build up cash value, and you can access that and withdraw it, okay, for college tuition. So you get something now in 10, 15 years when your child is ready to go to college, you can pull money out to pay for that. Down payment on a home, you can do the same thing. I was just talking to somebody up in Sacramento earlier this week, and they said they had done that to buy they just bought a new home, and they did that. They accessed their cash value, took out a loan against that to buy it for the down payment on a home. And retirement needs, which creates a stream of tax-free cash distribution for life. So imagine that. You go into your retirement years, Social Security gives you $14,000. On average, you're going to spend $46,000. So this helps to close that gap, gives you that monthly tax-free. There again, there's that tax-free. Because you're accelerating the death benefit, there is no tax that you pay on that. And once again, it's for a lifetime, except for those of you living over 121, okay? So, the power of indexing. Now let's look at this a little bit. With our flagship product, IUL product, you never have to choose between safety and aggressive growth. Now, what do I mean when I say safety? If you're concerned about safety with your money, what does that mean? That means that you want to be absolutely sure that your money is always going to be there, no matter what. Nothing is going to cause that money to go away. That means you can't put it under your mattress, right? Okay, you can't bury it in the backyard. Somebody could find it and dig it up. Where would be a good place to put your money if you just wanted to make absolutely sure that it was safe and it was always going to be there? A bank. Everybody's reluctant to say that because banks have kind of a bad name, right? But exactly right, it is a bank. And why is a bank safe? Because of what? FDIC, Federal Deposit Insurance Corporation. If the bank goes broke, FDIC insures your money, so it's going to be there for you. Okay? You don't have to worry. Well, somebody said not too long ago, well, yeah, David, it only insures up to $250,000. That's right, per bank. So you just, if you got $500,000, you put half of it in one bank and half of it in another bank, and you're covered, okay? It's absolutely safe and secure, right? Now, there's one problem with that, though. What kind of return does the bank pay you on your money? Not much, right? Not much at all. Matter of fact, today, probably what, 1%? Less than 1%. Okay. Yeah, it's not much. It's not much. You're not getting rich on what you're getting paid, right? It's safe, but you're paying for that safety because you're not getting a lot of return. But here's the thing. There's this thing called inflation. Now, inflation, the best way to describe it, I think, is whatever something costs you today, how much more is it going to cost a year from today? And right now, inflation is running about an average of 2.5%. So everything that you buy today, a year from today, will cost you 2.5% more. Okay? Now, if you're earning, let's say you are earning 1% on your money, but everything is costing you 2.5% more, you're really losing money, aren't you? It's safe, but your money becomes worth less every year because of inflation. So others will say that doesn't work for me, so I want more growth. I'm a little bit of a gambler. I'm willing to take some risk in order to get more aggressive growth. Now, if that's the case, if you're a little bit of a gambler and you don't mind a little bit extra risk, where might you put your money that would give you potentially a greater return? Stock market. Yeah, another thing that we don't like to say, stock market. Well, why don't we like to say it? Well, we're going to see that in a little bit. But the stock market can generate more income for you. Here's an example, and if you, in this example, put your $100,000 in the stock market, and this is based on the S&P index. If you put $100,000 in 1998, this is what the growth and loss of your income would look like. Over here to where today it would be worth almost $204,000. Now the problem here, 100,000 turns into 204, that's not bad, but look at the roller coaster ride that you're on, okay, all the way along. Here, after 1 year, your $100,000 grew to $119,500. Boy, everybody was walking around with big smiles on their face back then if they had their money in the stock market. And then what happened in 2000? There was what? Yeah, it was a crash. What was the crash? Do you remember? We forget very easily, don't? Huh? Not 9/11. Well, 9/11 happened, but that didn't cause the crash. It was the tech bubble burst. See, back then, yeah. No, it was real. Back then there were a lot of tech companies. Everybody was tech crazy, and tech companies would come out and they wouldn't be making any money. They'd be losing millions of dollars, and everybody would invest in them because they thought they might be the next Microsoft or Google or whatever. And Facebook wasn't even developed back then. So all of a sudden, though, as time went on, these tech companies weren't making any money, and everybody said, wait, I don't think there's any value here. And all of a sudden, everything crashed. And look what happened. For 3 years, the stock market went down, and this almost $120,000 turned into 71. But it hit bottom, came back up, got back up to the same $19,500, and then what hit in 2007, 2008 time frame? Another bubble. What was it? The real estate bubble, right? Real estate values crashed. I've never seen anything like it. That was just like driving off a cliff. It just went down. And look at this drop from $119,500 to $73,000 in 1 year. And then it went back up and leveled off here a little bit, dipped a little bit there, went up. And last year we had a little bit of a dip. It's back up now and looking good. But you can see this is like a roller coaster. So there's risk involved. You got to have a pretty strong will in order to smile through this and smile through that. So a lot of people can't do that. But here's the good news. Indexing combines the best of both strategies. It gives you the safety and security where you're never going to lose your money and a better growth potential than the 1% the bank is going to pay you. As a matter of fact, here's the graph showing if you had put your money in an IUL in 1998, This which graph shows you what would have happened to your money had you kept it in there for 20 years like this other one. Now, you see the big thing here, when this market crashed for 3 years, look what happened to your IUL. Never dropped. See, that's the thing with the IUL. It provides you with the opportunity for gain, but it never gives you a loss. The worst you can do is zero. Zero is your hero, right? Would you rather have zero during this period of time or this loss? And look what happened here during the real estate crash. Okay, it dropped down again big here, this stayed level. So you're not starting from down here as it recovers, and that's how it works. Now, based on this, what do you think is going to happen sometime in the probably not too distant future? What are we looking at with the stock market? Another crash. Guaranteed. It's going to happen. The only question is how deep will it be and how long will it last? Will it be a deep one like this that lasted 3 years, or will it be a kind of a all-in-one shot in 1 year like that? But there will be another crash. Now, the people on Wall Street have a fancy name for that. They don't want to call it a crash, do they? That sounds bad. They say, we're due for a correction. Isn't that nice? Yeah, that means you're going to lose a lot of money. But it's a correction, okay? So that's how the indexing works. It guarantees that you will not lose money, but it also provides for better gain. Now, let's switch gears and talk about the second thing. So that is the first thing we do. We help people achieve financial security and peace of mind by helping them acquire these products so they can have the benefits that they give. The second thing I said is we give you an opportunity to build a business of your own in the financial services industry. So there's a tremendous need to help people achieve financial security and peace of mind. We saw those statistics, didn't we? And it says in 2017, the U.S. industry's net premiums totaled $1.2 trillion with a T. Trillion. That is larger than the gross domestic product of a lot of countries. And that's how big the insurance industry. So it's a big, strong, powerful industry, isn't it? Now, 48% of households are underinsured in life insurance by an average of $200,000. So that creates a lot of opportunity. But let's back up. I don't know if you remember the one slide I showed you that said 41% of people have no life insurance at all. Well, of those that do, half of them are underinsured by $200,000. So that spells huge opportunity. There is a big need out there in the marketplace, isn't there? So the question is, how can you take advantage of this tremendous opportunity? And that's what I want to spend the rest of my time in this presentation talking about, is how you can take advantage of this opportunity. Well, how do you do that? If you join FFS and begin building your